Well, hello friends, Mark Martella here, where I'm sharing with you some of my Money Matters tips. And today what I'd like to share with you, thanks to my good friend Carol Ponzio, who posed this issue to me, is some of the mistakes that retirees make that ruin all of their financial planning. And in preparing for a presentation I did at her condo association and doing some research, in my practice where I live here in Charlotte County, we have one of the highest median ages in the country. So I do have a lot of seniors as clients. But what I learned in my research is that the age group of 65 and above since 1991, the number of bankruptcies that they have filed has increased by 212% as the percentage of overall bankruptcies that are filed. And think about it. Think about how things have changed, especially from our parents or grandparents. There are not the pensions that were once offered before. And one of the interesting things is that back in 1991, a person's Social Security income was approximately 40% of what they relied on. Now, it's about 90% of what they rely on. And then just think of it's a couple, and what happens when one of the spouses die. Add on top of this the increase in healthcare costs, and you get to start to understand why we have so many senior citizens who are filing bankruptcy. Now, the things I'm going to talk about are things that you would do normally. You find that it's really nothing that unusual, but the consequences of it that I see on a daily basis are catastrophic. So let me just jump right into it. And we'll start with the first one that I see, and it's co-signing for a child or a friend on a credit card or a car loan. Your kid comes to you and says, look, I've had some bad credit issues, I just need you to co-sign on a loan. You'll be second, I'm first, you're second. Well, that is not true. Who's first or who's second? When you both sign on the promissory note for that car loan, you're both equally and jointly liable. There's no first or second. They're coming after both of you. Credit card. Worst idea in the world, co-signing on a credit card. If they can't get credit, it's probably because they've defaulted on other credit cards. What makes you think that they're going to treat your credit card that you have with them any differently? So, what happens when your child, your son, or your daughter defaults on this car loan? Well, first you're going to see your credit score drop about 100 points. What does that mean? Well, when you go for a credit, you're going to pay a higher interest rate, whether it's a car or a credit card or anything else, even a mortgage. But the big thing is, what will happen is you can be pursued for a deficiency judgment. And a deficiency judgment is the difference between what they auction the car off at an auction and what is owed on the note. And believe me, they're not getting anything close to really the true fair market value at these auctions. You get a new car for $30,000 and 6 months later your kid defaults. What's going to happen? Well, what's going to happen is that they're probably going to sell it for half that, and they're going to come after you for a deficiency judgment for $15,000. So what happens if you don't voluntarily agree to pay it? Well, then they sue you. When they sue you, if you have no defense or you ignore it like a lot of my clients do, then they get a judgment against you. And once they have a judgment against you, now they can levy on your bank account. If you are working, they can levy on your wages. Now, if you're receiving Social Security, that's protected. If you have a homestead, that's protected from creditors. But do you really want to be fighting a judgment on a car or a credit card that you had nothing to do with? I don't think so. So when your child asks you for something like that, you just have to politely decline, despite how much they cry and say how mean you are to them. The second one, which is even a worse situation, is taking out a second mortgage for your child to pay off credit card debt or start a business. I see that a lot. Well, really, the worst thing in the world, and here's what generally happens: the kid comes to you and says, "Look, I have this credit card debt. I want to consolidate it. Instead of me paying 29% interest, you can get a second mortgage at 6% interest. And I'll just make the payments on your mortgage. You'll never know anything. It helps me out, and I save a lot of money." You, being the good parent, you agree. You take out this second mortgage and pay off their credit cards, but what you didn't do is you didn't have them cancel the credit cards. You didn't take the credit cards and cut them up. And even if you took the credit cards and cut them up, they would ask for new ones. And eventually what happens is now they have all these credit cards that have zero balances on them. They're going to start using them again. And then the next thing that you know is they don't make the mortgage payment. And they don't tell you they make the mortgage payment. It's when you start getting the late letters that you're not getting a mortgage payment. So that's something you need to be wary about, because if you default on your mortgage, even a second mortgage, they can foreclose. Even if there's a first mortgage, people have this misunderstanding that if there's a first mortgage, they can't foreclose on the second. Yes, they can. And the property will be sold at a foreclosure sale subject to the first mortgage, but you're out of that house. So please never sign the mortgage over to your kids. And the worst case scenario, what makes this so bad is that you've taken unsecured debt, a credit card, and converted it to a secured debt on your homestead. That you can subject to lose. The homestead protection protects you from other creditors except 3 creditors. 1 is a mortgage, 2 are taxes, and 3 is a construction lien. So you've opened up the door to expose yourself, your household, your homestead to creditors that aren't even yours, they're your kids. So never, ever take out a mortgage to help out your kids for something like credit cards. The third, in the same vein, and I see this a lot, is co-signing on a student loan for a grandchild. I just have a bad connection, so I'm just going to try to fix something here. See if we get a little better connection. It doesn't look like it, so we'll keep going. So adding a child or co-signing on a student loan, generally for a grandchild. The problem with this is you can never get rid of a student loan. And the worst thing that I always see is that, you co-sign these loans, $40,000, $50,000, $60,000, and 2 years into their program, your grandchild decides that, hey, I don't like this and I'm going to switch, or I'm just dropping out of school and I'm going to travel across the country to become a forest ranger or something like that. And you're stuck with the bill. And the student loan companies, because they're federal loans, they have superpowers to try to collect. They can, levy against you without even suing you. So something you do not want to do is co-signing on a student loan for a grandchild. As much as you love them, as much as you want to help them get a good education, don't co-sign for them. One thing, if you don't want them to be saddled with debt for the rest of their lives, is take out a life insurance policy for them. It's much cheaper, and upon your passing, they'll have a lump sum that can pay off their student loans, whatever they are, even if they didn't get their degree. And you'll save a lot more money, and you won't have this headache that's over you that you cannot get rid of, even in a bankruptcy. Fourth one, adding a child to your deed for estate planning purposes. So a lot of people think, hey, I'll add my child to the deed so we can avoid probate. And that is one way to avoid probate. But again, by adding somebody to your property, you're now exposing that property to all of their creditors. So if they get sued or they get a judgment against them by Visa or MasterCard, while they can't affect your interest, it attaches to their interest. If they want to file for bankruptcy, it's an asset that's exposed to bankruptcy, and if that house is paid for and it's worth $250,000, now they have a $125,000 asset, which basically may prevent them from filing bankruptcy or having to file a Chapter 13 bankruptcy and paying back their creditors in full, merely because of a piece of paper where you decided to do a nice parently thing and add them to your deed. So again, that is why I will later talk about having some frank conversations with them. Also, why would you want to expose an asset that you like to give to them upon your passing during their lifetime, where they can be subject to a judgment that would attach to this property? How do you avoid that? Well, one way is to provide for it in a will, that they don't get the property until they get the will, but of course then you're going through probate. If you wish to avoid probate, then what you want to do is do a trust. A trust avoids probate. A trust acts like a contract, so you will provide in the trust that upon your passing, the property would go to whatever children you like in whatever proportions you like. But until you pass, nothing happens. There is no property transferred. You can change your mind, where you can't change your mind once you put something in a deed, because they're on the property as well. They marry somebody you don't like, that person now has an interest in that property, or at least the increase in value in that property. So always maintain control of your property. There's various ways to do it. There's ways to avoid probate while you maintain control of your property. Please do that. The fifth one is related to kind of the last couple I've talked about, and that's having a frank conversation about your finances and your children's finances to know where they're at. You need to have, if you're going to leave things to your kids, you need to know what their situation is like. If you have $100,000 to give to two of your children, but one of them has $50,000-$60,000 worth of debt and is contemplating bankruptcy, well, then maybe you want to do some alternate planning so that they don't get it right away upon your passing. Because if they're in a bankruptcy, even if they've already filed, and even if they got their discharge, in a Chapter 7 you may get your discharge within 4 months. If you were to pass away within a 6-month window of filing, that becomes an asset of the bankruptcy estate, and they're going to lose it. So if you don't have that conversation knowing where they're at, I know it's very difficult to have financial conversations, especially with family members, but you got to try to break that. You have to have that trust. If you haven't built that trust over the time of the lifetime of your relationship with your kids, that's another hurdle that I don't have all the answers to. But you need to know where they're at before you transfer things to them. On the same token, you need to share with them where you're at. I can't tell you how many times that I meet with children who are coming in with their elderly parents and saying to me, "Mark, we thought they had everything under control. They retired with $600,000 in Social Security. They should have been set." Well, because they didn't have these conversations, because they didn't realize that their parents did not adjust their living expenses, but were living in the same way as when they were working and had a lot more income. That $600,000 went pretty quickly. And now they're desperate with $30,000-$40,000 in credit card debt and only Social Security to live on, to the point where they can't even get by paying their mortgage and car payments, etc. The kids still have to come in and help. So you need to have those conversations with your children so they know where you're at. And at some point, and something that I've gone through with my own mother is, you may be unable to take care of your finances, may be unable to take care of yourself physically. And if dementia sets in, who's going to take care of you? Do they know where your assets are? I had one situation with a client. The wife calls me frantic. She's in France. Her husband, who took care of everything their whole lives, just had a stroke, and she needs money. But she can't get any money because he has all the passwords to all of their accounts. She doesn't know what they are. She cannot get access to her money because obviously they didn't have that great a relationship as far as the finances. Nothing necessarily bad about that, but not planning with the passwords. And fortunately, he recovered, but for about 2 months, she did not have access to her accounts. And they had to wait till she got back from Paris to actually go physically into the bank in order to withdraw funds. So you need to have those conversations with your children. As you get older, you have to assume that you're always not going to be able to take care of affairs. And unfortunately, it can happen overnight if you have a stroke or something worse. So please open up those lines of communications with your children. It's very important. If you don't have children that you can trust, then you need to find either a very close friend or a financial advisor, again, that you can trust. Unfortunately, we see a lot of elderly being taken advantage of by friends, family, church members. So just beware of who you trust. 6, and again, you'll see how all these relate and build upon each other. It's failure to set a realistic budget or even have a budget. Again, one of the problems is failure to change your lifestyle. So you retire, you have your Social Security income, maybe a small pension, but that's not enough to cover the lifestyle you've grown accustomed to. That lifestyle that includes going out to eat 4 or 5 days a week, going on vacations, going to shows with your friends, having cocktails at the local beachfront establishment. That eats through your savings very quickly. So you need to have a realistic budget for your life expectancy. Our life expectancy keeps increasing. Retiring at 65 or 70, you may have reasonably have 15 more years, maybe 20 years, where you need to generate this income. You can't blow through it in 5 years. You need to have a budget. And what's so surprising to me is so often when I meet with people, they've never prepared a budget. And one of the exercises I make them go through before they even come in to meet with me is to do a budget. And I laugh sometimes when they'll sit down, they'll do the budget, and they'll look at each other and they'll say, even if we get rid of all our credit card debt, we still can't make ends meet with these expenses. And that's the first realization. And that's why they're in trouble and sitting with me, because they haven't sat down. If you want help doing a budget, you can go to my website, very easy to remember, markmartella.com, and I have my ultimate budget planning tool. It's about a 5-page spreadsheet with everything pretty much that you can think of that you need to budget for. Go there, download it, it's free, and it will help you figure out where you stand on a monthly basis or an annual basis. But again, you need to set a realistic budget. So often, what I see people do is they'll make bad choices by taking out equity of their home in order to buy that Winnebago or that dream car or dream boat. 6 months later, somebody gets ill. They never really used the Winnebago. They can't use the boat, but they took out $40,000 down and still have a $40,000 loan on it, and the thing is now worth $20,000. So please set a realistic budget. Preserve your assets unless you have money to throw away. And so many of my clients and so much of the American public right now over 65 do not have those type of funds. And finally, a problem that I see are reverse mortgages. Now, reverse mortgages per se are not a bad thing, but how you use them when you take them out, your lack of understanding of how they work can be a bad thing. So, 2 bad decisions that I see is somebody taking it out too early. You can take out a reverse mortgage at the age of 62, but that may cause you problems down the road. The other problem I see is people just don't understand how they work. So with that in mind, let's start with just some key concepts that you should know about reverse mortgages to understand them. So first, you can only borrow up to 60% of the equity in your home. So if you're looking to get rid of your mortgage payment, but you only have about 10% equity, that's not an option. Now, there are two types that you can get. You can get a lump sum, where you just get a lump sum, pay off that mortgage, and basically not have that mortgage payment. But keep in mind, when you're not making the mortgage payment on the reverse mortgage, each month there's interest accruing, and it just increases the amount you owe and eats into the equity that you have. So the interest is being paid by way of the equity in your home, and the amount that you owe each month goes up a little bit. Big problem, this is where I see a lot of foreclosures on reverse mortgages, is people either don't understand or forget that they have to pay the taxes and the insurance. If you've gone most of your life with the bank taking the money out of your mortgage payment and being put away as an escrow, don't assume that's going to happen with the reverse mortgage. I can't tell you how many reverse mortgages I've seen in foreclosure because of the failure to pay. And sometimes they say, well, I just thought it was included in everything. Well, it's not. You need to understand. And one of the problems is, the banks are pretty lenient, and they may let it go for 2 years, and they may put force-placed insurance. So what was a small problem 1 year, now 2 years later, has grown into a $10,000 problem, and now you're facing the third year of where you have to pay the taxes and stuff. So people get put into a hole, and if they're on a fixed income, there are not a lot of solutions in that situation. Now again, the mortgage doesn't come due until the last borrower dies, so you have the right to stay there, even if it turns out that you owe more than what the property is worth. You still get to stay there, again, as long as you pay your taxes and insurances, and if you have homeowners association dues, you need to pay those as well. The other good thing is that it's a non-recourse loan. What does that mean? Again, should you be there long enough so that, or if the market changes and the values of the property go down and the amount that you owe is more than what the property is worth, the bank cannot pursue you for a deficiency, or again, the difference between what you owe and what the house is worth. So that's another upside of a reverse mortgage. What are the pitfalls of a reverse mortgage? Well, again, one of the things, as I mentioned earlier, is taking the money out when you're too young, at 62, because you don't know what the future is. You may need that, whether it's for repairing the roof or for medical issues, to help supplement things down the road. You don't know what's going to happen. But if you're taking it out at 62 and you've taken out your 60%, you're not getting another dime out of that house. What you're going to have to do is sell it, but then where do you live? So again, I recommend that you don't take it out at least until you're 75, barring any real emergency, so that you take out what you need. Maybe you take a credit line one out if you need to repair the roof, or so, the air conditioning, or some major change. You have the equity to pull from. But if you maxed out, took the 60% out when you're 65 and the market was kind of flat or goes down, again, real estate goes up, real estate goes down. As we record this, the real estate market is still pretty good, still increasing, but again, we know it's just a matter of time before things start to level out or start to go down a little bit. Don't take the money out until later in life, as late as you can. Here's another big problem that I see that really infuriates me, is because let's say you and your spouse are on the property. You're 62, your spouse is 58. Well, in order to qualify for a reverse mortgage, she has to come off the deed. So the mortgage broker you're tells you, hey, it's no big deal, just have her sign a quitclaim deed taking herself off the deed, so you can get the reverse mortgage. So you do that, they do the closing, the mortgage broker gets their nice commission, and you go your merry way, and you forget to add her to the mortgage. 10 years goes by, you pass away, she's not on the mortgage, she's not entitled to the property at the time that you took it out, And now, although she has an interest in the property, the terms of the note says when the last borrower dies, the mortgage becomes due. Your spouse doesn't have all this money hanging around, can't get a refinance based upon just her Social Security, so they foreclose. They foreclose, and your spouse has no place to live due to bad advice by a mortgage broker. So again, if you are contemplating this, don't rely on a mortgage broker. Talk to your financial advisor. Talk to a lawyer. Give me a call. I'll be happy to explain it to you so that you understand all of the details of it. Because yes, it sounds great. Hey, I don't have to make a mortgage payment anymore. But there are consequences to that. It sounds too good to be true. You know how that saying is. So those are the 7 things you need to think about to prevent financial disaster in retirement. You know, you may have done all this great planning, you may be in a good financial position. It just takes one mistake to put you in a bad financial situation. It takes one serious illness that may put you in a bad financial situation. Now, also, we can talk about it another time, the type of documents you should have in place. So while you're alive, not before you pass away, but while you're alive, that are necessary to also protect you and avoid some other challenges or family tragedies that I like to talk about. But that's for another day. So again, I'm Mark Martella. Again, if you like more tips and tools, please visit my website, markmartella.com. It's called Money Matters, and it has additional videos and articles and free resources to help you stay out of financial trouble, stay out of debt, and hopefully live a stress-free, debt-free life. Thanks for joining me.